There's a lot to digest today because we have the big cyber summit underway at the White House. We just heard briefly from President Biden. We're going to get news about all of that from Dan Howley in about 15 minutes, an update on what's actually transpiring behind closed doors at the White House. But we want to talk about where these markets are headed. And we invite into the stream Zach Griffiths. He is Wells Fargo Senior Macro Strategist. And with all this talk about cybersecurity, we can't avoid the fact that we've got a virtual Jackson Hole Symposium, the Kansas City Federal Reserve's annual shindig, that is getting underway. And I guess everyone's trying to figure out what Jay Powell is going to tell us on Friday. But does it matter? I mean, we know they're not going to do anything suddenly.
We think it matters, but would agree we don't think the Fed is going to do anything suddenly. And we really don't think Chairman Powell is going to indicate that they're ready to move policy anytime soon. If you look at the July FOMC statement, they did indicate that they have seen progress toward their goals. But if you listen to his press conference, he really walked that back and said they are still a ways off from that substantial further progress threshold. So we expect Chairman Powell to remain resolutely dovish, as he has been for a while now. And we think that could disappoint markets a bit, who have been focusing on other regional Fed presidents who have indicated they might be ready to taper sooner than later. But we discount that a bit because many of those policymakers aren't on the voting committee this year. So we think Chairman Powell remains dovish, and we are comfortable with our call that a taper is not going to get announced until December of this year to go into effect in January 2022.
Zach, you just mentioned that it could disappoint markets a bit. I guess, what do you expect the reaction to be if we do see a pullback? How significant could that potentially be?
When I say disappoint markets, I'm talking more of the rates market, where we think that if he does sound more dovish, then Treasury yields could come off a bit. We've had a nice bump over the past couple of days to the 130 to 135 level. Perhaps in the days following, they come down as Chairman Powell sounds a bit more dovish, and that takes a little bit out of interest rate volatility, which is what we've seen from his speeches really over the past 5 to 6 months. From an equity market perspective, we think remaining more dovish is probably a positive. As far as more near-term upside goes, our colleagues in equity strategy just revised up their year-end target pretty substantially. They look for another 8% increase in the S&P 500 this year. So we think that more room to run in equities, but when we look out to 2022, we do think the taper is in full effect and is probably completed by the end of that year. And that could be that could weigh on stocks a bit in 2022.
Zach, want to repeat what you just said. It's that technique to make sure I heard it correctly. You see them concluding the taper by the end of next year. That means no more asset purchases whatsoever, whether it be $80 billion worth of treasuries or $40 billion worth of mortgage-backed securities. Hasn't the market already priced this coming, priced that in when we talk about equities?
Perhaps, but we think that it's going to come down to what Chairman Powell says, not only this week, but how they assess the economy to the end of this year. And perhaps if they were to tighten more quickly, which is not what we're expecting, that could cause a little bit of bumpiness in markets. But at this point, we think the taper timeline is probably fairly well understood. They did indicate in minutes earlier this year that they would probably follow the same timeline as when they tapered the last time, and that concluded in about a 10-month time frame. So that is consistent with the messaging and probably has been fairly well understood by markets. If they were to change their tack and either taper more aggressively because they're making more progress toward their goals, specifically their labor market goal, then perhaps that gives a little bit of pause to markets and cause some gyrations.
Zach, what do you think is the biggest, hurdle for the market here going forward? Because we have the S&P above 4,500 for the first time. There's still a lot of uncertainty out there, not just what the Fed is doing. Of course, there's some geopolitical uncertainty as well. Does this at all, should this give investors a little bit of pause just in terms of where valuations are and relative to some of these uncertain factors that are at play right now?
I think caution is definitely the best approach when you look at valuations and sort of the broader public health and geopolitical backdrop we have. Certainly seen a resurgence in COVID cases. The Delta variant is proving to be quite a bit of a problem. So that's something that we're certainly keeping an eye on. And when it comes to economic growth, we still expect to have another couple quarters of robust growth this year, a downshift next year, but call it 4.5%. in annual GDP growth in 2022. That's still quite strong, but you do have to keep an eye on these geopolitical factors that have really taken a back seat for much of the past year and a half, as the focus has really been on the public health situation, and that could add a bit more of fog to the backdrop when you're really looking further out into the future.